we'd like to just give some updates on the Russia-Ukraine situation, the markets, oil prices. There's a lot going on. There's a lot of volatility in the market, more so than we've seen quite some time. Let's just talk about what's the status of the Russia-Ukraine situation. Really, it's kind of been stalled here so far. But like, where are we, and what are we looking at in terms of monitoring potential outcomes?
Yeah. So a couple things to look at. First is Russia making any progress? Is there any opportunity for an off-ramp for Putin to get out of this situation? Because it's clear that it's probably been much more difficult than he anticipated. They're making far less progress than probably anybody anticipated. Ukraine's putting up a heck of a fight. So, we're at the point now where enough economic, financial stress has been placed on Russia that if Putin is being logical, huge caveat, then he should be looking for an off-ramp to get out of this situation but still save face. What does that even look like? That's tough to imagine right now, but if you look for historical analogs, when the invasion of Georgia happened in 2008, basically the off-ramp there was, all right, we haven't established stability in the country. We've just created more instability, but hey, we're not going to be here long term. We've sort of done our job in creating enough instability. Let's say certain regions of this country will basically defect to Russia, and let's get out of here. Right. We've caused enough chaos. They're going to think twice. That could be the scenario from here. Obviously, if it were to go the other way, you would think, well, his back is really against the wall now. He has to be feeling a tremendous amount of pressure. And when your back is against the wall, sometimes you do stupid things. Right. And it's very difficult to say what he might do. But if he were to expand, if he were to start attacking nuclear sites in Ukraine, those have already been shelled, but actually consciously take them out, that could be a game changer for sure.
Yeah, any escalation from here would definitely not be good for the markets and for the Ukrainian people, obviously. The other potential is for this to drag on for quite some time. I think with the sanctions, it's going to be difficult for it to continue to drag on because he's going to have trouble funding the entire operation much longer with all the sanctions, as they're really starting to put pressure on them. So that's sort of how we look at the immediate volatility that's creating. I mean, oil prices, as we sit here today, have come down substantially from yesterday, as we saw a lot of talk about how we were going to support oil prices going forward, which is a very big positive. And so I think we may be seeing peak energy prices here, peak oil, unless something escalates from here, which is a good sign. In terms of what really is under the surface that we're looking at, it's what's happening next week with the Fed, as they come out to talk about what they're going to do. And can you sort of handicap our thoughts on what we think the Fed is thinking and might be saying coming in the next week?
What does this situation in Russia, Ukraine, and the spike in commodity prices that we've seen recently, what does that do to the path of inflation and how the Fed reacts to that? So what does it do to the cards and how the player plays the cards? In terms of the cards, headline inflation is not going to come down as quickly as we previously thought. Unless there is a very sudden, rapid decrease in commodity prices, this all gets resolved and we start buying Russian oil, or oil supplies in the oil is totally rebalanced to the point where now Russia sells everything to China, China buys less from OPEC, OPEC gives more to us. All right. Unlikely scenario, right? So the most probable outcome here is headline inflation is going to run higher for a long time. But the Fed looks at core inflation, which is critical. Because if, for example, you look at high gas prices starting to eat into consumption in the US, that should slow growth, but importantly, should also slow core inflation. Because we've talked about this big spike in inflation. It's a supply problem and a demand problem. There was a demand shock when stimulus and money creation happened. if demand for goods and services slows, that should allow core inflation to come down quicker.
Right.
This is a very difficult situation for the Fed. If they were to follow what the ECB has done, say, I'm going to look through this spike in headline inflation because it's driven by transitory factors, hopefully Russia, Ukraine, commodity prices, things like that, for what it actually means for core inflation and growth, which means it could slow both of those. Mm-hmm. And I'm going to take this as an opportunity to take a more dovish stance, maybe talk about hiking less, a shallower path of rate hikes going forward, because this is a very credible reason to do that. Right. And markets are already down 12%, mortgage rates are over 4%, short-term interest rates are up. The market has done a lot of hiking and tightening of financial conditions for the Fed already. Yeah. Why would they add any more salt to the wound if they don't have to?
And so we're still, as we sit here today, somewhere north of 6 rate hikes or in that neighborhood?
Yeah, right around 5.5 to 6.
6, okay. And so in our opinion, that's obviously going to drive more of what happens the rest of the year. So their reaction to these situations, hopefully Russia-Ukraine goes away, volatility comes down. Mm-hmm. Now we're dealing with the path of U.S. growth and inflation.
Right, right.
And any thoughts on, I mean, Europe markets have been cratered also, mm-hmm. and have corrected or in sort of bear market territory. Okay. What's the outlook in Europe?
Yeah. So the outlook for Europe in terms of growth is far more dire than it is here in the U.S. European GDP growth is far more dependent on Russian GDP growth. There's more trade, there's more import-export activity. And it looks very clear Russia is going to go into a deep recession or depression. In a matter of 2 weeks, their sovereign bonds went from investment grade to junk on the brink of default. That's how harsh these sanctions have been on Russia. And everybody either implicitly or explicitly putting an embargo on everything Russia. So in Europe, the situation is not great. The silver lining here is, for the first time in a long time, they have joint issued debt, which is excellent. Yeah. Because you've always worried about, okay, if Italy has to issue sovereign debt or Portugal has to issue sovereign debt versus Germany issuing sovereign debt, that's a very different situation. Germany is strong, the core, great fiscal budget, et cetera. So Europe is coming together to create money mm-hmm. for the entire bloc, because this is a common enemy. Right. It's a common crisis. And so you go back to everything we talked about during COVID. Well, yes, economic growth is bad for asset prices, but if there's enough money creation to offset those, then markets can rebound and go higher. Right. So that's the silver lining.
Great. So in terms of U.S. markets, what other things are we looking at in order to sort of project out how the rest of the year will unfold?
In the near term, and then obviously the rest of the year. In the near term, there are so many technical factors going on that are creating so much noise and so much intraday volatility. I mean, hedge funds cut their exposure by almost the largest margin on record last week. Yeah. Retail buyers have been continuing to buy mm-hmm. at a pretty strong pace. So we had a massive de-risking in the hedge fund and sort of smart money community, and we're down, somewhere around 12% from the highs. Right. We're double bottoming. So the S&P yesterday retested the lows from the morning of Russia's invasion of Ukraine. Right. So technically the picture is a mess. There are things going in all different ways. It's going to be very volatile. Have to go back to our outlook and focus on the things that we think are going to make the year from here. Because you could very easily, if there's good news on Russia, Ukraine, some sign of diplomacy, a lot of this excess volatility could be wiped out. Hedge funds could start to re-enter the market, and we could go up exactly in a day, 5, 6, 10%. So let's think longer term. We're thinking about the path of inflation. We're thinking about the Fed. We're thinking about the outlook for money supply growth and economic growth. This should be on the margin net better for money supply growth, because it should allow the Fed to hopefully take a less hawkish stance and a less hawkish path of hikes for the end of 2020 through 2022. Economic growth, that is the big question mark. Once again, a number of confluence of factors here. How sensitive is the US consumer to all-time high gas prices?
Mhm.
There are a lot of models that worked pre-COVID for that because we know what happened in the 70s.
Right.
You know, we know what happened in 2008. Most folks work from home now far more than they used to. And their gas as a part of their consumption basket, gas as a part of their wealth, very low, very much lower than it was before. So that's what we're watching. What does it do to GDP growth? What does it do to profit margins? What does it do to earnings?
Right. Yeah. So we'll keep monitoring this stuff. If you have questions, certainly reach out to us. We're happy to go through our process and discuss our outlook with you. And thanks, Mike, for giving us an update.